Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, January 10th, and you are tuned into On Trend, the show designed to keep you on the right side of the trend. So we're going to start with a review of the long-term picture because that establishes my trading bias. And with that, you'll see that SPY and QQQ are hitting potential reversal zones, short-term overbought, near resistance. We'll show you that there's still not any new highs to speak of, and breadth long-term remains bearish. Then I'll show you a nifty way to sort the sectors using CandleGlance charts, and we'll finish with a rundown of the sector charts and the weightings in each sector for the broader market. Let's start with some weekly charts and the long-term trend. So I'm going to start off with a weekly chart because I want to keep the bigger picture in focus because that is the most important thing. I talked about the Zweig breadth thrust on Tuesday, and yes, we did have some bullish breadth thrust in the Zweig indicator for the NYSE and also for the 80% indicators. But as I'm going to show, the bigger picture is not bullish by any means, okay? We have seen false signals before from these breadth thrusts. How you tell a false signal from a real signal? Well, that's, of course, a tricky question. But as far as I'm concerned, there is scant evidence. I don't see any evidence that we're back in a bull market environment. I still think the bulk of the evidence favors the bears. And if we look at this weekly chart here for the SP 500, which is, my base case for the stock market there, you can see we had this consolidation on the way up, and that was a bullish consolidation within an uptrend, all right? And then we got the breakout to new highs. We had the breakdown below the 200-day, and the breadth indicators turned bearish, and then we had another consolidation. But this consolidation was after the breakdown. So whereas this one in early 2018 was a bullish continuation pattern, this one here in late 2018 was a bearish continuation pattern because consolidation, the bias depends on the direction of the previous move. So here in early 2018, the prior move was clearly up, and here in late 2018, the prior move was down, all right? And sure enough, we broke down and continued lower. Now, when we look at this chart, we can see that clearly the S&P 500 is well below its 40-week moving average, which is equivalent to the 200-day moving average. It hasn't even recovered this break here. You can see it broke support there with that triangle. It hasn't even recovered that. We basically have a throwback to that area, and I'll show in more detail, which I would expect to be our first resistance level. And as far as, turning bullish on the market, I need to see new highs. I need to see more stocks above their 200-day EMAs and probably see the S&P 500 get above 2,800. So I'm not in any rush to call a bottom here. All right, I still think the bulk of the evidence is bearish. Now, the indicator window shows the 26-week slope, and the slope is based on the linear regression. And in order to illustrate that, I need to do a little annotation here. So I'm going to click annotate. We get a new window. And if I go over to the left, I'm going to click the Roth regression channel. And then I'm going to extend that. And I'll just start here at the beginning of January. And I'm going to extend it 26 weeks. So that means we're going to go until the end of June, basically. That's going to be 6 months. And I'm going to go ahead and color that a dark blue so you can see it. So this is the linear regression, that middle line there. And you can see it's clearly sloping up. And if I click that and hold it and then drag it, all right, you can see how it changes the slope. So here we are in the latter part of 2017. The slope is still positive, but less positive than it was back here. And that's what this indicator below is measuring, the slope of this middle line, the linear regression. So you can see it really steepened here in April 2017. You can see it was above 10 down there, all right? And if I keep moving this up, look how steep it got in the beginning of 2018. It was above 15. So fast forward here, and after this long consolidation, the slope did turn down. but we held above the 200-day or the 40-week moving average for the most part. In other words, there wasn't a point when the slope was negative and we were below the 200-day on a closing basis. We closed below the 200-day moving average. I keep saying the 200-day, sorry, it's the 40-week. We closed below the 40-week moving average once and then right back above. So at no point was the slope negative and the close was below the 40-week moving average. And then the slope got going back again positive. But now if we look here, we can see that the slope, when did it turn negative? Well, right there, you can see we were positive and now negative. So it turned negative. That would be in November, the middle part of November. And clearly the slope is very negative now. So we have a negative slope. We're below the 200-day moving average. We hit a 52-week low. We broke below those lows from the early part of 2018. So clearly the bulk of the evidence on this chart says we're in a downtrend, not an uptrend. So here's the equal weight S&P 500, because one of the knocks against the S&P 500 is that it is weighted towards large caps, so the biggest stocks dominate it, and that is true. The top 50 stocks do dominate the S&P 500. So to get a more balanced approach, we can look at the S&P 500 equal weight index, which I'm showing here. You have $SPX EW. So that tells you how is the average stock performing in the S&P 500, and it's not good either. All right, you can see a clear break below the lows from 2018, below that low that we had in October. We've bounced back above it, but I'm not calling that a failed breakdown or anything. I still look at the bulk of the evidence, and when you look at it here, you can see that we had a break below the 200-day. The 200-day is sloping down. We had a little consolidation and we broke that consolidation. And you can see that the slope, the 26-week slope, is negative. All right. Again, it was negative here in May and June, but not at the same time that the index had closed below its 200 or 40-week moving average. There you can see there's a line. We're well above. We had that slope going there, and then the slope was negative here, but we were back above the 40-week. But again, the average stock is not doing so well, so we're in a downtrend. SPY and QQQ become overbought and near resistance. So while I'm on the charts for the S&P 500, I'm going to go straight to some 6-month candlestick charts for SPY, QQQ, MDY, and IJR, because they are really at a moment of truth for this counter trend bounce. And as I'll show you in a minute, I'm going to look at some of the breadth indicators as well. But, if you say that, or you assume that we are in a long-term downtrend based on the weekly charts that we saw, then that means when you get close to a resistance level, when you get short-term oversold, when you retrace 50 to 62% of a move, you grow very cautious. All right. In a uptrend, if the bull market was on, then I wouldn't be worried about resistance levels and overbought levels short term. All right. But that's not the case right now. The case, I think, right now is we are in a bear market environment, and that could mean some sort of a choppy trading range. It could mean further declines. But what it doesn't mean is we're not in a bull market. And when we're not in a bull market, we have to change the way we're looking at the market and think differently. And that's why when we get to, you can see we have this support level that held basically in late October and mid-November, and again in the early part of December. And then we broke down with a very sharp decline. And that was a huge decline, like 15%. And now we've got a 10% bounce, but look where we've returned to. All right, we've returned to broken support, which turns into resistance. And this is some classical technical analysis at work. In addition, you can see that this bounce has retraced 50 to 62% of the prior decline. So it's like you have 2 steps down, 1 step back up. So in a bull market, you have 2 steps up, 1 step back. But in a bear market, 2 steps down, 1 step back up possibly. So this is a potential resistance level to watch for a possible reversal and a decline again. Then we look at the momentum indicator, RSI, you can see it's in that 50 to 60 zone. And I've got 14-period RSI in this first window here, and that's default RSI. That's what Wells Wilder used. And it hit resistance there, you can see, in that 50 to 60 zone in early November and in late November, and now we're in for another possible resistance test. Now in the lower window, I've got 5-period RSI. And that's just to show you if you want to see an overbought reading, you just have to shorten your RSI period. And you can see here we're getting overbought again. We were overbought in early November, in late November, and now here in January. So if you look at the broad market environment, if you're short-term overbought on the S&P 500 and the long-term trend is down, this is a very precarious spot. So these are the charts that I showed last week, but a similar situation with QQQ. There you can see the broken supports turning into potential resistance, and we're in that 50 to 62% retracement zone right now. You can draw the Fibonacci from up here to the high. It's kind of like a fielder's choice which high you want to pick. For this instance, I picked the most recent high because clearly you have a very substantial decline, and we're tracing part of that decline. And so that's why I decided to focus on the December decline to base my Fibonacci retracements. And you can see RSI is also coming into its 50 to 60 zone, and 5-period RSI is slightly overbought. You can see it just moved above 70. And when we look at MDY, we can see a similar pattern unfolding. It's a little bit weaker. And why is that? Well, there you can see the broken support zone, and we haven't even reached it yet, whereas SPY and QQQ did. Same thing with RSI in the 50 to 60 zone and 5-period RSI just above 70. And then we look at IJR, which is small caps. We can see a similar situation as mid caps where they did not move back into that zone, that support zone here. So a little bit of underperformance in small caps. But, still you can see in the 50 to 60 zone and short-term overbought there. There are still no new highs virtually, and the majority of stocks are in downtrends. So this next chart shows the S&P 500 equal weight index with a 50 and 200 day, just for reference up there at the top window. And then I've got what called a high-low pair. We've got exclamation point, new high SPX, and exclamation point, new low SPX. And you can see the green bars are new highs and the red bars are new lows. So you can get a good idea of where the highs and lows are. I've got a line at 50, which is 10% of the S&P 500, plus 50 and minus 50. So you can see there's that move below minus 50. So basically more than 10% of the S&P 500 started hitting new lows in mid-October, and that was significant. It showed a significant increase in the number of downtrends. Now, the reason I'm showing this chart now is you say, well, do we have a Zweig breath signal? Is it time to turn bullish on the market? Are we in a bull market? Well, we had 0 new highs in the S&P 500 yesterday. All right, you're not in a bull market when you have 0 new highs, and we had 1 new low. And we look at mid caps, we had 1 new high, and we look at small caps, we had 6 new highs. So we basically had 7 new highs out of 1,500 stocks, and that for me does not qualify as a bull market. And that's why I am not bullish on the market right now, or one of the reasons. Now I'm going to go ahead and scroll down a little bit so you can see the full charts. But we became way oversold when you had over 200 new lows in the S&P 600 there in late December, and over 30 new lows in the NASDAQ 100. And now we're back to 0. And so this might be the oversold bounce. And now we're not oversold anymore, and we could continue lower. Now I'm going to do one more thing. I'm going to click on this chart and let you see the settings below on how I set this up, because we got a real nifty a high-low pair indicator. You can see price up, down pair. All right, and then I did new high SPX, comma, new low SPX. And so that puts those pairs there up and down. So now back to another reason why I am still bearish on the broader market. Yeah, we did get the breadth thrust, but I showed you 7 new highs out of 1,500 stocks. All right, this next group shows the percentage of stocks above the 200-day EMA. And the reason I'm using EMA is because that's what the indicator is that we have. I don't think it makes that much of a difference if you use EMA or SMA. But if you look at the percentage above the EMA, there's the actual number that we have on the right-hand side. 30% of S&P 500 stocks, 23% of mid-cap stocks, 27% of small-cap stocks. So, on average, 27% of stocks in the S&P 1500 are above their 200-day EMA. That does not sound like a bull market environment to me. And that's another reason why I am not long-term bullish or not taking that Zweig breadth thrust too seriously. I need to see these indicators get above 60% to show enough uptrends out there to take a bounce seriously. Now, scrolling down, I've got the advanced decline volume percent indicators for the S&P 1500, S&P 500, S&P Midcap 400, and S&P Small Cap 600. There you can see the symbols over there, dollar SUP, UDP. So this is basically advancing volume minus declining volume divided by total volume. So it's net advancing volume as a percentage of total volume. And you can see that we had a big move up in advancing volume there 4 days ago. That's the S&P 500, that second window I'm showing. And there's the Christmas Eve surge when we got that big move above 80%. So those were two 90% up days. But look what happened the next 3 days as the rally extended a little bit. Okay, the up volume started to decline relative to the down volume. Okay, net advancing volume declined, and it wasn't very strong yesterday. If you look at mid caps, it's been pretty flat, so it held up. But small caps took a little bit of a hit. But this is what's probably most concerning is the hit in large cap volume over the last 3 days as far as the volume in advancing stocks. So it tells you it's dwindling. So this little bounce could be on thin ice. And then another indicator that I showed before is the percentage of stocks above the 20-day EMA. And there's 2 ways to use this, either in an uptrend or a downtrend. So you can see here when the market was trending higher from May until September that you would be using it for bullish signals. And what does that mean? So when you're trending up from May to September, you would look for oversold readings. And I'm going to go ahead and just show these 4 windows so you can see the signals a little bit better. So you can see oversold technically is a move below 30%, but we didn't quite get there in late June. So sometimes you don't get enough of an oversold reading. We did get one in the NASDAQ 100, and that gave way to a nice bounce. All right, but then in October, things changed. All right, we moved from looking for oversold readings to looking for overbought readings. So we got an overbought reading in early November, and I showed you 5-period RSI was overbought in early November. We got one there in late November, early December, when 5-period RSI was also overbought for the NASDAQ 100. Now I'm going to go ahead and scroll back up so we can see what it looks like for the S&P 500 because that's the index we're comparing it to. But there we are. We're above 70% of stocks above the 20-day EMA, and you peak soon after that. It doesn't happen every time, and sometimes you can stay overbought. So you kind of need to get a move back down to signal that we're starting to get some selling pressure. So a move back below 70 would be the first signal, and back below 50 would suggest that we're going to at least retest that December low, if not break it. Ranking the sectors using CandleGlance charts. All right, so before I look at the individual sector charts, I just want to show you some nifty ways to look at these sectors using the CandleGlance charts that we have. So I've created a chart list here, and it's got the 11 sector SPDRs. And you can see I put a little numerical prefix in front of the names, and that's because I want these 6 at the top. I think they are by far the most important sectors. The simple reason is that these 6 account for the lion's share of the weighting of the S&P 500. Anybody want to guess how much? Is it 50%, 55%, 60%? Try 78%. So these 6 sectors account for 78%. And there you can see the other 5 sectors account for just 22% of the S&P 500. So sure, you can trade in them, you can rotate into them, rotate out of them. But if you want to know what the broader market's going to do, you need to focus on the big 6 up here at the top. And XLK is still the big one. It's 22% of the S&P 500. So it is the biggest sector by far. But if you have a chart list with all the sectors, you can view in CandleGlance format, which is what I've chosen here. And I get my custom CandleGlance chart by default. I'm going to change that to 2 months. And then I'm going to add an indicator that I want to sort by. And I'm going to add the percentage price oscillator. And I'm going to change this to 1 for the short moving average, 200 for the long moving average, and 1 for the signal line because I really don't need it. And I'm going to sort descending. And I'm going to click go. And so that's going to tell me where the price is relative to the 200-day moving average for the 11 sectors. So you can see on the left-hand side of each chart, you have the PPO value. And for the utilities sector, it's at 0.90, and after that, it's negative. So that means 10 of the 11 sectors are trading below their 200-day EMAs. Healthcare is around 0.41% below, REITs around 0.9% below, and then it gets worse quite quickly. There you can see Staples 2.3%, communication services 2.5%. If we scroll down, we can see there is the S&P 500, which we'd use as a benchmark. It's 4.2% below, and then the rest of them are further below their 200-day EMAs, and that would be technology, industrials, and finance, 3 big sectors well below their 200-day EMAs, and that tells you that the overall picture for the market is still bearish. Now we're going to look at some of the individual charts, and over on the left I've got the holdings. You can go to the SPDR website to find these holdings if you would like. And there you can see XLY is 10.25% of SPY. And the new sector alignment began there on September 24th. So the blue shading on each of these charts kind of shows a support zone that was broken there in December. And you can see XLY has moved above it and above its 50-day moving average. So it's one of the better performers as far as the better bouncers is concerned over the last 2 weeks because it got back above that support break. But you can see RSI is in that 50 to 60 zone. So it is getting at the point where momentum typically reverses after an oversold bounce. We look at communication services. It had one of the stronger bounces. And again, I call it one of the stronger bounces because there's that kind of support zone. And you can see we broke below it with that decline. And then we moved back above it with the advance and back above the 50-day. I don't use the 50-day as a resistance level per se, but it's a level you can use to compare other ETFs or price charts. And these two are above the 50-day. So they managed to get above the 50-day EMA. And anything that didn't shows a little bit of underperformance, if you will. But look, RSI is in that 50 to 60 zone, which makes it a very dangerous place for this ETF, XLC. We look at technology. All right, now here's a clear example of underperformance because there you can see that kind of support zone that was broken and we didn't even get up to it. We're below the 50-day moving average. So you can see XLK is lagging the other two in this regards because it didn't get above its 50-day. And there you can see RSI hitting that 50 to 60 zone. We look at finance. This is one of the weakest performers during the bounce. There's that kind of support zone that was broken. There's the 50-day. We're well below it. We're well below that support zone. So finance had one of the weaker bounces. It also had one of the stronger declines from early December to late December. But now it is running into a potential resistance zone. RSI is just above 50. We're just below that broken support zone. So this advance could terminate here. We look at industrials. You can see that XLI is 9.3% of SPY. I'll go back up to point out finance is still a big sector. It's 3.3% of SPY. And by the way, technology is still the king, 9.9% of SPY. So if we look at industrials, we can see again, there's that support zone that was broken. And we got back up to the lower end of it. We're still below the 50-day EMA, and RSI is in that potential reversal zone, 50 to 60. Materials getting one of the weaker bounces as well. Well, it's back at the 50-day. It's not above the 50-day, and you can see it's right near that support break, which turns resistance, and RSI is in that 50 to 60 zone. And, materials is just 2.7% of SPY. Not that important of a sector for the broader market. Energy got one of the bigger bounces, but you can see it's still below its 50-day moving average, and it's still below this, support zone that was broken. So overall, it's still one of the weaker, even though it had one of the stronger bounces the last 10 days. Healthcare has a big double top on this chart. All right, you can see the two highs there in September and then in late November, early December, and then the support zone that was broken. We moved back above the break and back above the 200-day, but looky here, broken support turning into resistance. We're just below the 200-day as well, and I bet you if you do your Fibonacci retracements, you're near a 50% retracement, so this rally in healthcare could fizzle here. Consumer staples, one of the weaker sectors. All right, you see this big decline and then a throwback. There's broken support turning into potential resistance. And utilities barely even bounced over the last few weeks. And I dare say a bearish continuation pattern is forming. All right, you had the sharp decline. And now you've got a pennant. So this is like a consolidation after the decline, and that means it's a bearish continuation pattern. And if you break down there, it argues for a continuation lower. And utilities are only 3.2% of SPY. Have to go to the next page now that there are 11, and that would be REITs. And REITs are all over the place. All right, even though they're back above the 200-day and maybe showing some relative strength long-term, you got to ask yourself, is it worth owning stocks in this environment? Because REITs were above 32 back in July. So they're still down over the last 5 months or so, and they've gone nowhere. If you like broadening patterns, maybe that's a broadening pattern. I never was a fan of those patterns, but this is not a chart you want to be owning because it's not a clear trend. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.